Hey finance experts, welcome to the Easy A Show. I'm your host Zach Blessing, and this is my ratio analysis. Here we did two industries, first being the restaurant, fast food industry. We have Yum! Brands who broke off of PepsiCo. They are part of Taco Bell, KFC, and Pizza Hut. We have McDonald's, Jack in the Box, Wendy's, and Papa John's. Here we'll see that the current, this is going to be our short-term solvency, meeting current liabilities with our current assets. Here we see that Yum! Brand, they were not able to do so as far as their current ratio is concerned, not able to meet those obligations in the short term. But when we look at their cash here, their cash ratio, in the most liquid state, they're still not able to meet those obligations. So this poses a little bit of concern for Yum! Brands. McDonald's does a fairly good job, almost 2 as far as their current ratio, meaning that they're able to meet those current liabilities. For their cash ratio, in their most liquid state, they're still able to meet anything that is uncertain as far as meeting the short-term obligations. Here we'll see that Jack in the Box is around 0.63 on average for the 5 years, and here we'll see that that is not good as far as meeting your current liabilities. Their cash ratio here is pretty terrible. We see that it's 0.05 on average for the 5 years, meaning that they are not able to meet that with their cash in their most liquid state. Here we see that Wendy's is probably our winner in short-term solvency, 2.2, and then their cash ratio is 1.2, meaning that they are able to and efficient at meeting their short-term obligations. Papa John's here has had some solvency issues last year, around 2016. So here we'll see that the current ratio is 1.2, shows good, but their inventory and the receivables makes up most of that. Their cash ratio is 0.15 on average, meaning that they have short-term, meeting their short-term obligations poses a threat, poses a little bit of concern. So here, we'll see that the current ratio trend here over the 5 years. We'll see that McDonald's had some growth, mostly in 2015, with some expansion globally, opening up some new stores and new franchises. They capitalize on a lot more than just the franchises. They own some of the property that they make rent income off of for the franchisees. So we like how McDonald's is looking here. The rest we'll see on average is above, a little bit below for 2 of the companies, but mostly our industry is above with the current ratio, meeting the short-term obligations. So now we're going to long-term. So when we're talking about leverage here, we're talking about the equity multiplier. Across the board, our 3 companies, Jack in the Box, McDonald's, and Yum, had close to the same amount of leverage. Here we'll see that Wendy's had a little bit less, but Papa John's has a great amount. The equity multiplier here actually is more due to the drop in equity that they had around 2016. So now we need to see, with this leverage, can you meet that? Can you actually pay the creditors your interest expense, the creditor money that you've received? Can you pay that back? So with their earnings, Yum! Brand can almost 10 times. McDonald's on average about 13 times. Jack in the Box about 8, Wendy's 2, and Papa John's 45. This has to do with their earnings staying the same, but like I said, their solvency issues and things like that. So they're able to meet that creditor payments, but we do pose some threats and concerns as far as what's going on with their solvency in the short term. Here we see the equity multiplier on average is around the same for the industry. We have Papa John's who has a big jump in 2016 due to a great amount of leverage increase along with a drop in equity. So here, the time interest earned, we see Papa John's as our outlier here. They're able to meet those obligations fairly well. Here we'll see that the drop has kind of stayed consistent, which this has driven our 5-year average up quite a bit. Here we'll see that they're about around the 30, almost to the 20 mark here. But for the average of the industry, you're doing pretty good there as far as meeting your obligations, paying creditors back. Here we'll do the ROE decomp. So Yum! Brand, a lot of this average here is driven by them breaking off a Chinese stores that they have, are planning to make them their separate private entity. And before they did that, they were actually paying a great amount back to shareholders before that split happened. So here we'll see that ROA is mostly driven by a higher asset turnover than a lot of the peer group and a profit margin with an operating margin, which is what actual management is able to control, is done fairly well. So here with the leverage they have being around the same as the others, we like how this looks. Now the ROE is driven up by some concern with that split and that payment back to shareholders before that happened. So McDonald's here is 37, Their ROA is 14. They could do a little bit better with their total asset turnover compared to the group here, but their profit margin is where they shine. Their operating margin is what, like I said, managers can control, and they do a very, very good job of doing so. Jack in the Box, their ROE is driven mostly by their total asset turnover, being greater than a good amount of the peer group, Wendy's and McDonald's. So here we'll see that their operating margin is a little bit lower. Here we got Wendy's, it's around 8.5, being the lowest ROE in the group. They have a good amount of short-term solvency, but as far as long-term, we have a little bit of concern. Their total asset turnover is the lowest in the group. So here we'll see that the operating margin is around a little bit higher than Jack in the Box with less leverage. So they're doing okay, but not as good as some of the others in the peer group. Jack in the Box, like I said, the ROE was driven by the drop in equity that they had. They actually have a very high total asset turnover compared to the group with a profit margin that's the lowest. So really what's driving their ROA to be high is their total asset turnover here. This is the trend here for ROE. You can see Papa John's has a steady increase here, a little bit more in 2015. McDonald's too has had pretty steady, but the growth has really come in 2016 with their expansion. So the return that they've made with global expansion to shareholders is fairly good, going from 15 to 16. Here we'll see the total asset turnover for the group. You have Yum! Brands at 1.26, 0.76 for McDonald's, the highest being Papa John's, like we said. But for the most part, everyone here has stayed pretty steady as far as their total asset turnover is concerned. We believe that McDonald's has a little bit of an opportunity to do better with their global expanding. So here we'll see the PE in the market. So the PE ratio pretty much tells you don't want it to be too high, but this tells you the price you paid based off the earnings last year for the company. So if you were to pay, say, $24.56 for that, you would earn back $1. So here we'll see that we don't want it to be too high. High means that there's growth potential for the company. Low we don't want, but we don't want it to be too high as well. So McDonald's kind of fits that range. The main concern here with McDonald's is our market cap to book is a little bit lower than what the assets are valued on the books for. But really they shine in their economic value. They are a big company that's been around for a very long time. So the enterprise value is pretty high there. The enterprise multiple is pretty much the PE ratio, but for the whole company. So here we'll see that the 11.83 tends to be pretty high as far as the peer group, with their economic value added being the greatest out of the peer group for McDonald's. So there we like that a lot. The weighted average cost of capital with the return that, that shareholders require gave us an economic value added spread of 12.3. So it turns out to be the third best in the peer group. But like I said, our concerns are with a lot of Papa John's, with their market to book being so low and their solvency issues and their drop in their equity. So here we'll see the only real downside that we can kind of find from McDonald's is their high stock price. So this is the PE ratio. You see some growth here, pretty much for McDonald's, and then a little bit of a dip. But for the most part, we're okay with that. We like a steady growth in the PE ratio, but we don't want it to become too high, showing that stock might be overvalued. So here we can see that it's possible that Wendy's has been overvalued in 2013 with their drop here. So the last price, with McDonald's, we have some steady growth here. For all our other industries, we've had some pretty steady growth across the board, but with McDonald's being a higher price, it can show us that the market highly values a company that's been around for a long time that has efficiency in paying dividends at a growing rate. So here's the suppliers. McDonald's has the most suppliers, leaving them the less risky as far as if a supplier were to go belly up or things like that, which helps diversify what they do as far as their operations. So they're the best in the peer group as far as their suppliers are concerned. They don't have too much of weight in one supplier. They're able to spread it out and able to do a good job there. So here, McDonald's is the winner out of this peer group. The current ratio is above 1. It's consistent for the past 5 years. They have medium leverage. They follow the average for the industry. They have the efficiency to cover that interest expense. You see it's been greater than 10 from 2012 to 2015, meaning they can pay their creditor funding 10 times over. Strengths are the third largest ROE, and that's mostly due to their profit margin, especially their operating margin, what managers can control. So the growth of the PE with the growth in the stock price shows that this might be a good investment for me, strictly because the dividends here have had a pretty steady growth along with their earnings and overall. So the weakness here is probably their total asset turnover. They can do a little bit better job as far as generating revenues from their assets. So next industry is the telecommunications industry. You have AT&T and Verizon being probably your closest competitors here, probably top dogs of the industry. You have the CenturyLink, T-Mobile, and US Cellular. CenturyLink does more of wireline services. US Cellular does a little bit more of the cellular side, but maybe not as big as T-Mobile, Verizon, or AT&T. So here we'll see the short-term solvency. Current ratio for AT&T is 0.76, for Verizon 1.19. So here we'll see that AT&T does not have the means of covering the current liabilities. And when we look at the cash ratio, we see that they actually don't have it in their most liquid state to pay back their current liabilities that they have. Verizon has a higher amount, but a lot of theirs is in accounts receivable if we look at the quick ratio compared to the cash ratio. So they can pay about half of their current liabilities back, which is still pretty good compared to some of the competitors in the peer group. CenturyLink, they have a terrible cash ratio as far as meeting their obligations in the most liquid state they have. If they had to meet it now, they would not be able to. The only one in the group that could is T-Mobile with 1.2. Their current ratio is 2.12. So here's the trend of the current ratio. We see that Verizon goes up and kind of dips down as far as meeting that, meaning that 2013 had more revenue, more assets earned. You have accounts receivable and cash that have earned here in 2013, pushing that up. But if we look at the trend from the beginning to the end, we're about the same. So we had a little volatility, but we've kind of never gone below that mark that we've started in 2012 with. So we see the trend here. This is where T-Mobile was valued a lot, but we can see that the current ratio has dropped a little bit there. So if we're looking at the long-term debt now with their equity multiplier, so this shows how levered a firm is. AT&T, 3.10, pretty good amount of leverage as far as the industry average. Verizon is highly levered compared to the peer group at 10.51. 3.1 for CenturyLink, 3.5, and 1.9 for the others. So we see that the highest leverage is definitely with Verizon. Our next question now is, can you cover that liability? Can you cover that leverage, with the earnings that you have? Can you pay the creditors back with the earning expenses? So here, the interest expenses. So here we'll have the AT&T can meet that 4 times over. Verizon is a little bit better at meeting the leverage concerns. So here we'll see that the battle is really between AT&T and Verizon when it comes to long-term solvency. So next we see the equity multiplier. Equity multiplier, again, has increased for Verizon. They've taken on more leverage, but leverage can magnify gains. It can also magnify losses. So we have to be concerned, but that's why we looked at the time interest earn ratio to see how well a company can actually pay that back. AT&T and Verizon kind of have the same trend here, but Verizon has a little bit better of means of paying back their interest expenses with their earnings. Here you see that ROE decomp, AT&T at 11.51. This is really driven by their profit margin, and their operating margin here is pretty sufficient as far as the peer group. Their equity multiplier, meaning their leverage, is a little bit lower. So Verizon has a higher return on equity, and this is mostly due to their leverage. So if we were to take that leverage away, we would still have a pretty decent ROE compared to the rest of the peer group here. So where they lack is more in their total asset turnover, but for the average of the peer group, you really see that that's kind of the average there. They're doing pretty well. So their operating margin is the highest of the peer group, what managers can control. So they're doing a really good job there. CenturyLink, lowest ROE compared in US Cellular, lowest ROE. This is really driven by low asset turnovers and profit margins compared to the group. So here if we look at the operating margin, US Cellular does not do as well of a job as the peer group here at controlling what managers have control over. So if we look at the ROE trends, we see that for the most part, everyone has kind of stayed below the 20% mark. but really Verizon has had the big growth here with some growth in net income comparatively to the equity funding that they have. So here the total asset turnover, you look at T-Mobile had a big spike in 2013, but mostly we see that it kind of leveled out. Everyone here has had a pretty consistent, Verizon has had a little bit of growth, but overall has stayed around 0.5. So now we're looking at the PE and the market to book ratios. So PE ratio here, we don't want it to be too high like we said. It can show some overvaluing of the stock, but we have some pretty decent levels for AT&T and Verizon. T-Mobile and US Cellular kind of get a little bit out of hand. We do show some growth potential in these companies, but for the PE ratio to be that high, we believe there might be some overvaluing there, especially with a low market to book ratio, meaning the expected future cash flows of what shareholders have in the business currently. So here we'll see that Verizon kind of does the best as far as their market to book. The market really values the use of their assets, what their assets can do. Enterprise value is the total value of the company. AT&T has a little bit higher number there, but and the enterprise multiple is pretty much the PE ratio for the whole company, showing that AT&T is a little more value than Verizon here. But for the most part, our economic value added is a really good indication of a growing and good firm. 10,559 for Verizon there, being the top in the peer group. After the weighted average cost of capital and the return that's required by shareholders, we see that the economic value added spread is 4.9, being the highest in the peer group here. And this shows in the stock price on average was around 47 for the 5 years, showing that there is value from the market in Verizon stock. So here we see the PE ratio. T-Mobile had a year where people valued them very high. I believe that they were overvalued, as you can see, with the drop in the PE ratio. But for the most part, we have consistency with Verizon and AT&T here. So the last price, if you look at, we see some growth in Verizon over the 5-year period here. We see AT&T have a little bit of growth towards the end, but for the most part, we have a little bit higher price in Verizon because of the value of the stock, the dividends that it pays, and things like that. So here we see the suppliers. AT&T has a little bit more than Verizon, but overall these two are the top competitors. They really do well as far as diversifying the risk with their suppliers. CenturyLink and US Cellular, a little bit lower, a little bit smaller companies, so they have a little bit lower amount of suppliers along with T-Mobile. So not too much concern there, but for the most part, for a big company like AT&T or Verizon, we're happy with the amount of suppliers they have. So here Verizon is our winner. The current ratio is above 1, meaning that they can pay the short-term solvency issues that they would have. They can pay those back. Leverage is the highest of the peer group, but with time interest earned, we can see that they can actually cover that interest expense. They have the highest ROE. It's driven by the total asset turnover, but mostly by the profit margin. So their operating margin is the highest of the peer group here, and the leverage magnifies their ROE. But like I said, leverage is an issue if you can't cover it. Leverage does magnify gains, it magnifies losses, but we see with Verizon, it magnifies gains. Here we'll see the strengths, again, total asset turnover and profit margin. But what I want to bring to your attention here is the dividends growth. We can see that it has grown over the years, making this a good investment as far as the portfolio is concerned, bringing in cash flows with a stock that has some steady growth. So comparatively, we'll see Verizon and McDonald's here. Both do very well in their own ways. Verizon is a little more levered, but they can cover that expense, magnifying their ROE. So their ROE is a little bit better than what we see McDonald's to be when you break everything down. But really where we have some concerns with McDonald's is their total asset turnover. So really, the best out of the two would probably be Verizon. These are both safe investments that pay dividends back, that have grown, and have grown pretty decently. So we think that the best would be the Verizon to put into the portfolio, which it already is, for a good reason. For the dividends that it creates and cash flows that you get, along with the growth and the potential with the PE ratio growing as well. So here we'll see McDonald's WACC page. So the weighted average cost of capital for 16 was 6.3. The big key here is their economic value added spread ended up being 15.51%. with our required return on the interest capital to be 21.78%. So here we're okay with the amount of debt to their equity that they have, and we can see that their weighted average cost of capital has actually gone down over the years. So we like how the McDonald's is run. They've been around for a while and they know how to run. We see Verizon here. Their economic value added spread is a little bit lower, but compared to the peer group that they have, they've had the highest economic value added spread over the 5 years comparatively. Their weighted average cost of capital is a little bit lower than McDonald's. They do carry a bigger amount of debt, but like we said, we're okay with that because their time interest earned can actually cover the debt that they have. Here we see the dividend discount model. This was through Bloomberg, giving us a theoretical price of $50 when the closing price is about $47. So we're saying that the actual price at $47 is a little bit undervalued than what our dividend discount model gives us. Here I've actually taken the dividends that I've given using the earnings per share and the payout ratio to project it for 2017 through 2019. So if you find the average of the payout ratio and the average earnings per share growth, we can actually calculate what the earnings per share were and take the payout ratio of 69% and actually find what our dividends are. And we still have growth in the dividends, and they have gotten to a high point here with this projection. So we think this would be a good investment to put into the portfolio. We found the price here using the PE ratio and the earnings per share. Same thing, growing the earnings per share at 15% with the PE ratio dropping a little bit at 6%, which we're okay with. Like I said, we don't want necessarily too high of a PE ratio. It could show overvaluing. But even with a decrease in the PE ratio, what we have is the price here has grown significantly. So at 53.3 at 2016, grew to 57.71 to 62 to 67. So we show with this dividend, with this projection of dividends and projection of stock price, that this would be a significantly good investment as far as the portfolio is concerned. You have dividends and cash flows coming in. You're okay with the amount of leverage because they can cover that leverage. Leverage magnifies gains. Our ROE decomp, we have a good return to shareholders there. So overall, we believe this to be a safe bet, pretty much a safe investment for a portfolio to gain cash flows and to maintain the growth. Here I back tested pretty much what the dividends would be using the dividend discount model, what the price of the stock would be if you were to buy it at 2012. So here we have 2012 growth. I used the 1-year treasury rate as my risk-free rate, found the beta in 2016, the S&P 500 return, and the closing price in December 2016 for Verizon. So here my cap in is 7.13%, and when you do the dividend discount model and add these together with the selling price discounted back, you get a stock price at 2012 of 48.038. What did the price close at in 2016? 50.91. So here we see that the stock price can be a tiny bit overvalued by maybe $2 to $3, but here we're okay with that. We're okay with the growth that we have from this. We're okay with the dividends, and this is a sufficient and great investment as far as the portfolio is concerned. You have diversification benefits from it, and overall Verizon has a very sound structure. They have surveys that say that their service is better than AT&T's, better than Sprint. They use a certain frequency called CDMA, which a lot of people have happy times with. They pretty much have coverage in rural areas, big cities, and their customer service is better comparatively to a peer group. So here we see that Verizon would be our best bet to leave in the portfolio, which is already there for a good reason. I'm Zach Blessing, and this was my ratio analysis.